I don't know whether either of you were able to hear our earlier conversation, and with the caveat that, number one, it wasn't even 3%, but it was an incredible sort of reversal. Chris, do you have a fundamental reason to explain it, and do we need one?
I unfortunately don't have a fundamental reason to explain it. I think any rally that we have will certainly take, but when you're looking at what could happen or what could explain that rally, a lot of it had to have been driven by technicals. We saw some monetization of very large hedges. We saw monetization of short positions, and we saw some very oversold conditions, just generally speaking. I think the question that we have to ask ourselves, though, is that question: has anything fundamentally changed? And the answer is no. The CPI data that we received only emboldens the Fed in terms of essentially locking in a 75 basis point hike in November and certainly increasing the probability of another one in December. So the Fed's in the driver's seat, tight financial conditions, and so it's too early to call an equity bottom here.
What about your thoughts, Victoria?
No, I think there's a lot of information that regards to the positioning going into yesterday's CPI number, and I think that's why we saw such a reversal. We had the expected result after the CPI number. We saw the market come down again based on what we think the Fed is going to do with that data. But again, like was mentioned with Kristen, there were short coverings. I think there was a lot of action going on in the put markets. So there were people coming out of some of those put positionings after they saw the markets go down. So yes, there's not a true fundamental reason. I do think maybe you had some people that had cash on the sidelines deciding to come back into the market at this point in time. You were speaking a little bit earlier about when do you come in. No one wants to really try to chase the market or time the bottom exactly. But when you've had these down days, what we're doing for our clients is going in and nibbling a little bit here and there on names that we like in order to build that position out. So when we do hit the bottom, we're well positioned.
How many that we also, as you heard us talking, I think, Chris, about maximum potential downside from here, timing the markets. Any maximum potential downside is just a probability. Nobody knows. I guess we could go down more than 20%. We could go down less than 20%. Are you smart enough to get that last 10% move and buy right at the bottom, or is it time to buy some and then if it goes down, buy some more in names that you like, that you think could benefit in whatever environment we're going to be in?
I think, look, one thing is that market timing is next to impossible. So this idea that anyone is going to get that right is just a loser's game, quite frankly. And look at what happened yesterday. So the truth of it is the worst days in the market are followed by the best days in the market. And if you're out of the market, just for on average, the two best trading days of each year, you reduce your per annum return by upwards of 80%. It's actually around 9.5 percentage points. So we don't advise market timing. I think the real question right now, though, is this debate between, are we in a recessionary bear market or are we in a non-recessionary bear market? A non-recessionary bear market, we've done most of the work. This 25% down in U.S. equities, we're already there. Those are the averages that we see in non-recessionary bear markets. In recessionary bear markets, you can see declines exceeding 30% and closer to 35%. And our base case right now is actually to expect a recession starting in Q1 of next year. So we are invested in the market, but we're definitely defensive and positioned in quality.
Victoria, same notion here?
Yeah, very similar in the sense that you want to focus with all the volatility that's going on, and we think you're going to continue to see that volatility because, look, no one knows for sure what the path of central banks is going to be. Yes, we anticipate the Fed will now do 75 in the November meeting, probably 50, maybe 75 in December, but I think there's also a huge question as to what other central banks are going to do. How far are they going to push the limit, which is going to fold through into the dollar. It's going to fold through then into the earnings for these multinationals. I think earnings could be a huge component for us. Obviously, we start with the banks today, but we've seen expectations come down over 6% this quarter for earnings expectations. So the question is the bar low enough to where numbers actually beat expectations. If they do, we could see another rally in the market. So I think you need to have a little bit of cyclicality in your portfolio to take advantage of those, but still have some defense because we're not sure that we've hit the bottom, as we mentioned a moment ago. So you need to be in a balanced portfolio with some maybe healthcare names, some insurance names, but also some retail names or some cyclicality in there to take advantage of moves.